I want to tell you about a number, not a billion, not a million, not even 100,000. The number I want to talk about today is $1,000, because I believe that $1,000, deployed with patience, discipline, and the right framework, contains within it the seed of something that most people living paycheck to paycheck genuinely cannot imagine. It contains the seed of complete financial freedom. I know what you are thinking. You are thinking that a man worth over $100 billion telling you that $1,000 is meaningful sounds like something between a cliche and an insult. You are thinking about your rent, your student loans, the car repair you have been postponing for 3 months. $1,000 does not feel like the beginning of a fortune when you are staring at a stack of bills on your kitchen counter. I understand that. I was not born wealthy. My first investment was made with money I had earned delivering newspapers in the cold Nebraska mornings before school. I understand the weight that a small amount of money carries when it represents real sacrifice. But here is what I need you to understand before we go any further. The size of your starting capital is almost entirely irrelevant to the outcome of your financial life. What is relevant, the only thing that is truly relevant, is the quality of the decisions you make with whatever capital you have, and the quality of those decisions is determined entirely by the framework behind them. Today, I'm going to give you that framework, the exact same one I have used for 70 years, scaled precisely to where you are right now, starting with $1,000. There's a story the financial industry tells, quietly, implicitly, through every advertisement and platform it builds, that investing is something you begin doing once you have already accumulated a meaningful amount of money, that it is the destination of financial discipline, not the vehicle of it, that you should first pay off every debt, build a 6-month emergency fund, max out your retirement contributions, and then, once all of that is handled, perhaps consider putting something into the market. This story contains just enough practical wisdom to sound responsible, and it is designed, whether intentionally or not, to delay the single most powerful variable in the entire mathematics of wealth building, time. Every year you wait to begin investing is a year you cannot get back. Not because of the money you failed to invest in that year. $1,000, more or less, will not define your retirement, but because of the compounding years you permanently forfeit. The mathematics of compounding are not linear. They're exponential, and the exponent gets dramatically more powerful the earlier it begins working. Let me give you a number that I want you to carry with you for the rest of your life. If you invest a single one-time payment of $1,000 at age 22, and that money compounds at 10% annually, which is roughly the long-run historical average return of a broad index of American equities, by the time you are 65 years old, that single $1,000 investment will have become approximately $73,000, without you ever adding another cent. Wait until age 32 to make that same investment, and you will have approximately $28,000 at 65. The identical decision, made 10 years later, produces 60% less wealth. You did not work less hard. You did not invest less wisely. You simply started later. The minimum is not a dollar amount. The minimum is a decision. And the best time to make that decision was 10 years ago. The second best time is right now, today, with whatever you have in your pocket. Listen to me, my friend. I am about to tell you something that will surprise many people who follow my career closely. Something that sounds, on the surface, like a contradiction coming from a man who has spent his entire life picking individual stocks. If you are starting with $1,000 or $10,000 or even $50,000, and you do not yet have the time, the training, or the temperament to analyze individual businesses with genuine depth and rigor, the single best investment you can make is into a low-cost index fund that tracks the 500 largest companies in America. I have said this publicly, I have written it in my letters, and I will say it again here as clearly as I possibly can. The vast majority of professional money managers, people with Ivy League degrees, Bloomberg terminals, armies of analysts, and access to management teams I have to schedule months in advance, do not beat a simple S&P 500 index fund over a 20-year period. Study after study, decade after decade, the data is unambiguous and frankly humbling. Most active management destroys value relative to simply owning the market. When you buy a low-cost index fund, you are buying a fractional ownership stake in 500 of the greatest businesses ever built by human beings. You are buying a piece of Apple and Microsoft and Johnson & Johnson and Berkshire Hathaway. You're buying the collective ingenuity, the accumulated infrastructure, and the compounding earnings power of the American economy. And you are doing it at a cost so low, some funds charge less than $3 per year for every $10,000 invested, that the fee is essentially irrelevant. With $1,000, this is your foundation. Open a brokerage account. There are several reputable platforms today that require no minimum balance and charge no trading commissions. Purchase shares of a broad, low-cost index fund. Set up an automatic monthly contribution, even if that contribution is only $50. And then do the hardest thing in investing, nothing. Do not check it every morning. Do not sell it when the market falls 15% and your stomach drops with it. Do not move it into cash because a television personality told you a recession is coming. Plant the seed, water it consistently, and let it grow undisturbed for as long as you possibly can. Before I tell you how to deploy the rest of your first $1,000 into individual stocks the way I do, I need to tell you about the investment I made that produced a higher return than anything I have ever put into the market. I was 19 years old and I was already convinced. I knew enough about investing to be dangerous. I had read Benjamin Graham's security analysis. I had been buying stocks since I was 11. I believed with the particular confidence of a young man who has had some early success that I had figured out the essential secrets of the game. Then I read The Intelligent Investor by the same Benjamin Graham, and in the space of reading that one book, a book that cost me less than the price of a modest dinner, my entire framework for thinking about markets, risk, and value was rebuilt from the foundation up. I enrolled in Graham's class at Columbia. That education cost me a few $100s, and it produced a return that is mathematically incalculable. I am not telling you to enroll in an expensive university program. I'm not telling you to purchase a $1,000 online course from someone who became wealthy, selling courses about becoming wealthy. I am telling you that a deliberately chosen library of serious books, not financial news, not social media content, not the opinions of YouTube commentators who discovered investing 18 months ago, represents the single highest leverage use of a portion of your first $1,000. Read The Intelligent Investor by Benjamin Graham. Read Common Stocks and Uncommon Profits by Philip Fisher. Read Poor Charlie's Almanac. Read the complete archive of my annual letters to Berkshire Hathaway shareholders, which are available for free online and represent, I believe with genuine immodesty, one of the most comprehensive practical educations in business and investing ever assembled in one place. This is not a detour from the investment strategy. It is the investment strategy, because the returns you capture from the market are a direct function of the quality of the decisions you make, and the quality of your decisions is a direct function of the quality of your mental models. You are building the machine before you run it. Every $100 you invest in upgrading your financial education today will influence every investment decision you make for the next 50 years. No stock, no fund, no asset class offers that kind of leverage on a $100 investment. Analytical, but accessible. Make it feel achievable. Now, let us say you have taken care of the foundation. You have your index fund position. You have invested in your education. You have some capital remaining, and you want to begin building your skills as an analyst of individual businesses. How do I think about that first stock purchase when the capital available is limited? I start with what I know. Not what is trending on financial social media, not what a podcast guest mentioned last week, not the stock that your brother-in-law squares is about to double. I start with businesses that exist within my genuine circle of competence, industries and companies that I understand deeply enough to form an independent opinion about their long-term future. Here is the practical exercise I would give to any new investor trying to identify their first individual stock. Walk through your daily life with a notepad, physical or mental, and write down every business whose product or service you cannot imagine living without. The coffee you drink every morning, the software you use at work, the retailer you return to again and again, not because it is the cheapest option, but because the experience is simply better. The credit card network that processes your transactions, the pharmaceutical company whose product has meaningfully improved the lives of people you love. You're looking for the businesses where your loyalty is not rational, where you would continue using the product even if the price increased by 20%, where the thought of switching to a competitor produces genuine friction, inconvenience, discomfort, a sense of loss. That irrational loyalty is when you encounter it at scale across millions of customers, one of the clearest signals of a genuine economic moat. Once you have identified 2 or 3 candidates from your own life, you then apply the analytical framework, the moat, the management, the financials, the valuation that I described in detail in our previous video. You read the annual reports, you study 5 to 10 years of financial history, you form your own estimate of intrinsic value, and then you wait. You wait for the price to come to you, not the other way around. This is the discipline that separates investors from speculators. The speculator asks, what is the market doing right now and how do I position myself to profit from the next move? The investor asks, what is this business worth and is the market currently offering it to me at a discount to that value? If yes, I buy. If no, I wait. The waiting is not passive. It is active, disciplined, and enormously profitable when you have the patience to practice it. With a limited amount of capital, I would own very few positions, perhaps 1 or 2 individual stocks alongside my index fund. Concentration, when it is based on genuine conviction and thorough analysis, is not reckless. Diversification without understanding is what is truly reckless. Owning 20 stocks you barely understand is not safer than owning 3 you know deeply. Motivational shift. Let the math do the emotional work. I want to show you something, not a projection, not a fantasy. A mathematical reality that is played out with remarkable consistency across more than a century of market history. Imagine you are 25 years old. You invest your first $1,000 into a broad index fund today. And then, this is the important part, you add just $200 every single month. Not $2,000. Not $500. $200. The cost of a modest dinner out twice a week. An amount that most people reading this could find without any meaningful disruption to their lifestyle if they examined their spending with honest eyes. At a 10% average annual return, the long-run historical average of American equities before inflation, here's what that decision produces. After 10 years, you have approximately $42,000. After 20 years, approximately $153,000. After 30 years, approximately $452,000. After 40 years, at age 65, you have approximately $1.3 million. $1.3 million, generated by a person who started with $1,000 and added $200 a month, never made a spectacular trade, never picked a 10-bagger, never received a windfall or an inheritance, simply started, stayed consistent, and refused to stop. Now I want to show you something even more striking. Of that $1.3 million, only about $97,000 came from your own contributions. The remaining $1.2 million was produced entirely by compounding, by your money-earning returns on its returns, year after year, in a self-reinforcing cycle that grows more powerful with each passing decade. You did not earn that $1.2 million. You did not trade for it. You did not work extra hours or take on additional risk or make a single decision of any complexity or difficulty. You simply refused to interrupt the process. You owned the businesses. You collected the returns. You let time do what time does when you give it the right conditions. Compounding is not a strategy. It is a natural force, as reliable and as indifferent as gravity. Your only job is to stop fighting it. Stop withdrawing. Stop panic selling. Stop looking for shortcuts that promise to produce in 6 months what compounding will produce in 30 years. Get out of its way and let it work. Arius Tan. Speak with urgency. These are real dangers. Before I close, I need to warn you about 3 specific behaviors that I have watched destroy the financial futures of people who started with exactly the right intentions. People who understood the theory, made the first investment, and then undid everything through a predictable, entirely avoidable series of mistakes. The first mistake is treating the market like a casino. When you start investing with a small amount of capital, and you watch it grow, slowly, undramatically, a few percent here and there is a powerful temptation to accelerate the process. To look at options trading or speculative small-cap stocks or cryptocurrency or whatever the current vehicle of rapid wealth mythology happens to be. The promise is always the same, massive returns in a short time frame. The reality for the overwhelming majority of people who pursue it is also always the same, The small amount of capital they worked hard to accumulate is transferred swiftly and efficiently to the people on the other side of those trades, who are better capitalized, better informed, and far better equipped to exploit the emotional volatility of a new investor. The second mistake is selling during corrections. Every significant market decline, and there have been dozens in my investing lifetime, is accompanied by a media environment of pure, concentrated terror. Unemployment, recession, systemic collapse. The language escalates with the severity of the drop, and it is designed, whether deliberately or simply through the incentive structures of attention-based media, to make you feel that selling is the rational and responsible response. It is not. Selling during a correction does not protect you from the loss. It makes the loss permanent. The investor who holds through a 40% decline and recovers has lost nothing but time and peace of mind. The investor who sells at the bottom has converted a temporary paper loss into a permanent capital destruction. And having sold in panic, he will typically wait until the market has fully recovered or exceeded its previous high before buying back in, thereby ensuring he misses the entire recovery. The third mistake is the one I consider most insidious because it masquerades as prudence. It is waiting for the right moment to invest. There is no right moment. There has never been a right moment. At every point in my investing career, there has been a credible, well-articulated reason to wait. A geopolitical tension, an election uncertainty, a valuation concern, a recession fear. The investors who waited for those uncertainties to resolve never invested because those uncertainties never fully resolve. They simply change shape. Back on camera, warm, direct, personal, I began this video by telling you that $1,000 contains the seed of financial freedom. I want to end it by being precise about what I mean. The $1,000 is not the seed. The decision is the seed. The discipline is the seed. The willingness to take that money that could buy a weekend trip or a new piece of technology or 3 months of a premium subscription service, and redirect it into an ownership stake in great businesses, and then leave it there untouched, compounding quietly in the background of your life for decades. That is the seed. The $1,000 is just the first expression of that decision. It will be followed by another month's contribution and another, each one a small act of discipline, each one indistinguishable in the moment from all the other moments, but compounding over 40 years into something that will matter enormously, not just financially, but in terms of the freedom, the options, and the genuine independence it produces. I am 83 years old. I have spent my entire life doing exactly what I described to you today. And I can tell you with the authority of someone who has actually lived it, that no amount of money I have ever made has produced more satisfaction than the simple, quiet knowledge that I own a piece of the world's greatest businesses, and that those businesses are working for me every single hour of every single day, including the hours when I am sleeping, when I am reading, and when I am doing absolutely nothing at all. That is available to you, starting today, starting with whatever you have. If this shifted something in how you see your first $1,000, press the like button right now. Not for me, for yourself, as a signal that you heard this and you are choosing to act on it. Subscribe for more. We are building a library here for people who are serious about this. Every video goes deeper. Every video is built on the same foundation of patience, rationality, and genuine long-term thinking. The seed is in your hand. Plant it.